So imagine you're just looking at a stock chart, right? And you see this company that just plummeted 13.59% in a single day.
Oof. Yeah, that's brutal.
Right. It's a sharp falling trend. Momentum oscillators are just flashing red across your whole screen. And the retail sentiment feels like, well, it feels like a full-blown panic.
Well, absolutely. It looks like a textbook disaster scenario.
Exactly. But then you actually dig into the analyst coverage, and literally every single covering analyst on Wall Street is screaming, strong buy.
Which is wild.
It's totally wild. And to add to the confusion, the company's own insiders, like the people actually running the operations, are aggressively hoarding shares.
Yeah, it really is the ultimate market paradox, you know?
It really is.
You have this immediate, violent, short-term price action screaming one thing, and then the people closest to the actual underlying business are just screaming the exact opposite.
And that divergence is exactly what we are unpacking today. So welcome to the deep dive.
Glad to be here.
And hey, before we really get into the weeds, you know the drill. Like the video, subscribe to our YouTube channel, and definitely leave us a comment with your feedback. We read all of them.
We do.
So our mission today is to tear into the financial data, the technicals, the news surrounding Sidus Space Inc. Ticker symbol is SIDU.
Yep, SIDU.
We're basically going to figure out if this is a severely undervalued space tech play that the broader market is just entirely mispricing, or
if it's a highly dangerous value trap.
right, a trap just waiting to crush retail traders who are trying to catch a falling knife.
Which happens a lot.
Too often. Oh, and a quick reminder before we pull apart the balance sheet. This is an impartial exploration of the data. We are just debating the mechanics of the market for educational purposes.
Right. Absolutely no financial advice being given here.
None at all. So let's establish the baseline. What's the immediate catalyst driving this current weakness?
We have to look at April 21st, 2026. Sidus Space closed at $3.75 a share, following that brutal 13.59% single-day drop.
And, normally that kind of floor-falling action points to something catastrophic fundamentally, like, I don't know, a lost contract or a literal failed rocket launch.
Right, something blowing up on the pad. But looking at the tape, this sell-off was triggered entirely by the financial machinery of the company itself.
The offering.
Yeah. They priced and closed a massive $58.5 million equity offering.
Okay, let's unpack this, because mechanically it's dilution. It's like taking a pizza and just cutting it into way thinner slices.
Exactly.
Everyone's existing slice gets smaller because there are suddenly more slices. The open market adjusts the share price downward to reflect that new, larger pool of equity.
Yep, the market just reprices the float instantly.
But I always find this aggressive panic selling fascinating. I mean, they just secured $58.5 million in cold, hard cash.
It's a huge war chest.
Right. And for a capital-intensive aerospace company that, physically builds hardware, a fortified balance sheet should technically be a massive de-risking event.
You'd think so, yeah.
So why the violent dumping? To me, it says the retail base is just utterly exhausted.
Oh, they're completely exhausted.
Yeah.
And you really have to look at the historical context of the stock's volatility to understand the psychology there.
The 52-week range is pretty nuts.
It's crazy. Over the last year, this stock has traded as low as roughly 62 cents.
Wow.
Yeah, to 0.6278 and as high as $5.99.
A swing from 60 cents to almost $6. That is a roller coaster that will just destroy retail confidence.
Exactly. When a stock is that volatile, the shareholder base is constantly on edge.
Right.
So the moment that $58.5 million offering hit the wire, retail investors didn't view it as a strategic move for future dominance.
They viewed it as a lifeline?
Yes, a desperate lifeline just to keep the lights on. They're terrified. Their shares are being devalued faster than the company can actually grow its top-line revenue.
Which is a valid fear. And to figure out if that fear is actually justified, we have to look past the daily news cycle and rip open their 2025 financial statements.
We do.
Because look, management doesn't dilute their equity at these levels unless the internal math essentially forces their hand.
Yeah, the full year 2025 numbers paint a very stark picture. It's a company trapped in a really heavy transitional phase.
The income statement is genuinely tough to look at, I won't lie.
It is.
For the full year 2025, annual revenue actually shrank to roughly $3.4 million.
Right.
That's a 28% decrease year over year. For a company valued as, a growth stage tech disruptor, a shrinking top line is a massive red flag.
Oh, massive. And while the revenue was contracting, the operational losses were expanding pretty aggressively.
How bad did it get?
The net loss for 2025 widened to $29.5 million.
Ouch.
Yeah, which is a big jump from the $17.5 million net loss they posted back in 2024.
Okay, but to be fair, the filings do note that the $29.5 million net loss includes a $4.5 million non-cash impairment charge.
Right, that's an important caveat.
So they had to write down the value of an asset on the books. It's painful, but no actual cash left the building for that specific line item.
Exactly, it's just accounting.
But even backing that out, we are still looking at a $25 million operating loss against just $3.4 million in revenue.
And that ratio brings us to the operational efficiency, or the current lack thereof, really.
Wait, I'm looking at a gross margin of negative 168%.
Yep.
How does a company lose that much money on their core operations? In the software sector, you expect gross margins of positive 80%.
Well, they aren't software.
Right, but they are losing more than $1.50 for every single dollar of revenue they bring in just on the core cost of goods sold.
It's wild.
My immediate read on a negative 168% gross margin is that this has to be heavy upfront depreciation on their LizzieSat fleet hitting the income statement, like before the recurring revenue streams have actually turned on.
You nailed it. That is the defining dynamic of orbital infrastructure.
Yeah.
You don't just, build a satellite and expense it in a vacuum.
Right.
You spend millions bending metal, writing proprietary code, testing propulsion systems, securing launch capacity.
All before you make a dime.
Exactly. That immense upfront capital expenditure is then capitalized and depreciated over the useful life of the asset.
So it looks terrible on paper today.
Right. Sidus is absorbing those incredibly heavy infrastructure costs on their income statement right now. They're taking the financial hit today to build the physical foundation for tomorrow's revenue.
It really is the ultimate capital expenditure trap. You have to spend the money to build the fleet, but you can't build the fleet if you run out of cash.
Exactly.
Though looking at the balance sheet, their liquidity position at the end of 2025 actually provides some breathing room.
It does.
They were sitting on $43.2 million in cash and $35.7 million in working capital.
So they clearly have the runway to keep operating in the near term.
Right.
But that high operational cash burn, that persistent $20 to $30 million annual net loss, that is the absolute bedrock of the bearish argument here.
Because the bears just do the math.
Yep. They look at that $43 million plus the newly raised $58.5 million, and they just model out the burn rate.
And they figure if the revenue doesn't scale exponentially, the company is just going to have to come back to the market and dilute everyone all over again.
Exactly. It's a potent cocktail for a short-term disaster. Heavy cash burn, paired with shrinking year-over-year revenue.
You would rationally expect the smart money to be just sprinting for the exits.
You really would.
But looking at the actual ownership data, it reveals one of the most fascinating divergences I've seen in the market lately.
The battle lines are drawn very clearly on this one. On the short side, as of late March 2026, there were 7.43 million shares sold short.
Wow.
Yeah, that represents roughly 11.2% of the total available float. A very significant portion of the market is actively betting the price will continue to collapse.
And then the institutional money. The mutual funds and pensions that usually provide a stabilizing anchor for a stock's price, they are just completely sidelined.
Completely.
Institutional holding is sitting at a mere 9.74%.
They won't touch it.
No, they simply won't touch a high-burn microcap until the operational execution is entirely de-risked.
Right, so they're leaving the stock as basically a battleground for retail traders and short sellers.
But here's where it gets really interesting.
Oh yeah, the insider data.
Yes. This is the most compelling metric in our entire stack of research. Over the last year, company insiders have bought roughly $2.08 million worth of their own shares.
Across 100 separate transactions.
100 transactions, and the number of reported sales by those exact same insiders, absolute zero.
Zero. It's incredible.
So synthesize that for me. What do they know that the market doesn't?
Well, think about it. Institutional money is cautious because the immediate financials are ugly. The shorts are attacking because the momentum is downward and the dilution is mathematically real.
Right.
But the executives and the board members, the people who literally see the daily operations, who know exactly how the hardware integration is actually progressing,
They're buying.
they are buying with extreme, sustained conviction. They are aggressively accumulating equity on the way down.
Which points directly to a long-term vision that the short-term market is either ignoring or just completely discounting.
Exactly.
And that brings us perfectly to the bull case, which relies entirely on their pivot to this space as a service model, or
To
SPA.
space.
Right, space. It's an attempt to fundamentally change the unit economics of the entire aerospace industry.
Ambitious.
Very. Instead of operating as a traditional contractor,
Yep.
where you build a bespoke satellite for a single client, you get paid once, and you move on. They're building their own proprietary constellation.
I really love the analogy of building a toll road in space.
It fits perfectly.
Because building the physical highway is incredibly expensive. You have the heavy depreciation, the massive negative gross margin, and that brutal cash burn we just talked about.
Yep, the pain period.
But once that LizzieSat constellation is fully operational in low Earth orbit, the capital expenditure drops off a cliff.
And the margins then expand exponentially.
Exactly. Under the SPAS model, they can lease out data storage, sensor time, communications bandwidth, all to multiple government and commercial clients simultaneously.
Using the exact same orbital hardware.
Right. It transforms a lumpy hardware sales business into a highly profitable, recurring subscription revenue model.
Like a SaaS company, but literally in orbit.
Exactly.
And our sources outline some major upcoming catalysts that prove this toll road is actually getting built. First up is the LS-4 mission.
That's a big one.
They've recently achieved key integration milestones with Maris Tech for a targeted launch in Q4 of 2026.
And hardware integration is notoriously difficult. So hitting those milestones proves the engineering is actually tracking.
But the real validation for the SPAS model comes from the commercial contracts. They secured this massive $120 million lunar agreement with Lonestar Data Holdings.
Focused specifically on space-based data storage.
The mechanics of that are just fascinating to me. A $120 million agreement fundamentally changes the math for a company that only posted $3.4 million in 2025 revenue.
It's a total game changer.
And the concept of off-planet data storage is brilliant. I mean, terrestrial data centers are vulnerable to environmental disasters, grid failures, geopolitical instability.
Right, natural disasters.
So storing critical redundant data in orbit or on the lunar surface is like the ultimate fail-safe.
And securing a 9-figure agreement for that capability. It proves there's immense commercial demand for their specific infrastructure.
But the commercial side is really just one pillar, right?
Right. They're also heavily involved in massive government IDIQ contracts, like the MDA SHIELD program.
Okay, an IDIQ that's indefinite delivery, indefinite quantity, right?
Yep.
So it essentially means they have a hunting license to compete for task orders against a multi-billion-dollar ceiling.
Exactly. The Department of Defense doesn't guarantee the revenue up front, but it pre-vets a pool of vendors so they can rapidly deploy capital when needed.
So it's not cash in the bank today, but it puts Sidus at the table for billions in defense spending.
And being at the table is half the battle in defense contracting.
Oh, for sure.
The Missile Defense Agency is shifting toward low Earth orbit constellations for early warning and tracking. They're moving away from those massive single point of failure legacy satellites.
And Sidus is positioning the LizzieSat fleet to capture a piece of that multi-billion-dollar transition.
Right. And this massive backlog and future potential is exactly why the analyst ratings are so wildly disconnected from the current $3.75 share price.
The analyst consensus right now is a unanimous 100% strong buy.
Unanimous.
There isn't a single sell or hold rating on the board, and the average one-year price target is sitting at $10.20.
Which is huge. From the April 21st close, that implies an upside of over 170%.
So the analysts are completely ignoring the 2025 cash burn.
Pretty much. They're modeling out the realized revenue from the Lonestar agreement, the potential task orders from MDA SHIELD, and the eventual high margins of that space as a service model.
All right, so the fundamental long-term story looks incredibly promising. Insiders are buying, analysts are projecting massive gains, and the company is sitting on potentially billions in contract ceilings. But as investors, we have to respect the immediate technical reality.
We do.
The stock just dropped nearly 14% in a single session. So what are the technical charts signaling about the short-term downside risk?
Well, the charts are currently an absolute battleground. They're flashing deeply conflicting signals.
In what way?
So the moving average aggregates, which, smooth out price data over weeks and months, they're still technically flashing a strong buy.
Interesting.
Yeah, despite the violent recent drop, the stock has maintained a medium-term rising trend channel.
I see the moving averages pointing up, but look, those are lagging indicators. When I look at the momentum oscillators, which track the immediate speed and severity of the price action, The picture is violently bearish.
Very bearish.
The RSI is sitting at 38.8, dropping fast toward oversold territory, and the MACD has flipped negative to negative 0.178.
Yep, the momentum is heavily with the bears right now, and that's validated by 3 consecutive days of selling pressure.
So what's the technical floor here? What's the battleground?
Immediate support. The first level where buyers have historically stepped back in is at $3.67.
And we are testing that right now.
Exactly. The stock is testing that boundary today. If the selling pressure breaks that $3.67 level, the next major deep worst-case floor doesn't materialize until down near $3.
Wow. A drop to $3 would be a brutal capitulation from current levels.
It would.
On the flip side, though, if the market digests the recent equity offering and realizes, hey, the company just secured a massive multi-year cash runway, the upside resistance sits at $3.95.
Right.
If they can punch through that ceiling on high volume, the secondary technical hurdle is up at $4.90.
And then that massive volatility between those support and resistance bands is exactly why retail traders so frequently get trapped in these specific types of plays.
Why is that?
Because you have to understand the execution risk. It is uniquely binary in the aerospace sector.
Binary meaning it either achieves orbit and prints money, or it explodes on the pad and goes to zero.
Exactly.
Yeah.
Look at it this way. If a software company pushes a bad update, they patch the code the next morning, right?
Right.
If Sidus spends 3 years building a satellite, integrates it with Maristic, puts it on a rocket, and that rocket fails, the physical asset is entirely destroyed.
That's terrifying.
The downside risk is absolute.
So if the Q4 2026 LS4 mission is delayed due to integration issues, or worse, if the launch fails, the entire financial narrative collapses.
It shatters. That $3 support level would easily break because the path to that high-margin SPAN's revenue gets pushed out by years.
And the $43 million in cash plus the $58 million they just raised would just evaporate an operational burn.
Yep, requiring even more dilution before the revenue ever actually materializes.
It is an incredibly high-wire act. Which brings us really to the final synthesis of the data, the great debate here.
It's a big question.
Are we looking at a severely undervalued gem or a highly dangerous value trap?
Well, your conclusion depends entirely on your investment time horizon. And frankly, your tolerance for binary risk.
For the short-term traders.
The short-term perspective is dominated by undeniable weakness. You got the 13.59% drop, the aggressive $58.5 million dilution, the expanding $29.5 million net loss, and the heavy cash burn.
So if you are trading the next 3 to 6 months, the bears have a highly compelling argument that this is a value trap.
Without a doubt.
But the long-term perspective requires you to look past the current income statement.
Right.
If you zoom out, you see a company building the necessary infrastructure for a highly profitable space-as-a-service model. You see insiders buying millions of dollars in stock with zero sales.
Don't forget the contracts.
Right. You have a $120 million lunar agreement validating the tech, hardware integration milestones being met, and unanimous strong buy ratings projecting 170% upside.
For a long-term holder, that is the definition of an undervalued gem hiding behind the short-term noise of heavy capital expenditure.
And that tension is exactly what makes a market.
It is.
For every retail trader hitting the bid because they fear another round of dilution, there is an insider or an institutionally minded believer buying that exact share.
Because they see a multi-billion-dollar orbital infrastructure coming online.
It is such a fascinating tug of war between short-term survival and long-term dominance.
It really is.
So as you analyze the charts and the filings yourself, we're going to leave you with this final lingering question to ponder.
All right, let's hear it.
When a company is quite literally building its physical infrastructure in low Earth orbit, absorbing massive upfront depreciation to build a toll road in space, how much short-term dilution and cash burn are you willing to stomach before those rockets finally launch?
Honestly, it ultimately comes down to your conviction in the execution.
It always does. Thanks for taking the deep dive with us. We'll catch you next time.